Trump has not yet initiated a new round of the U.S.-China trade war, but the Chinese authorities are already in disarray, trying to combat the new tariffs by devaluating the yuan against the U.S. dollar. Public opinion believes this move will not only anger Trump, but also lead to further instability in Chinese society. On December 9th, the Chinese Communist Party's Politburo held a meeting to set the tone for economic development in 2025. The focus was on implementing more aggressive fiscal policies and moderately loose monetary policies, a phrase that hasn't been used by the Chinese government in 14 years. After the 2008 global financial crisis, China adopted a moderately loose monetary policy, but shifted to a prudent approach by the end of 2010, which has continued to this day. The statement from this meeting did not include the usual line about maintaining the yuan's basic stability. Clearly, under Xi Jinping's leadership, China's economic policies are shifting. According to sources cited by Reuters, China's authorities are considering allowing the yuan to depreciate further in 2025, potentially dropping to 7.5 yuan per dollar, in response to the significant tariff hikes that may follow Trump's return to the White House. This would mean a roughly 3.5% devaluation from the current level of about 7.25 the dollar. Following this report, stock markets in Hong Kong, Shanghai, and Shenzhen plummeted, causing the Hang Seng Index to fall below the 20,000-point threshold, shaking market confidence. The yuan's exchange rate against the dollar also briefly dropped to 7.28. President-elect Donald Trump said he is prepared to impose a 10% tariff on all Chinese imports and could gradually raise it to 60%. Beijing believes this plan is aimed at decoupling the U.S. from China, with consequences far beyond the trade war during Trump's first term. In the face of this severe situation, allowing the yuan to depreciate further could reduce the actual price of Chinese exports, helping to offset some of the tariff impacts. Reuters shared that this would likely set the tone for China's monetary policy next year. On December 11th, President Xi Jinping sent a congratulatory message to the U.S.-China Trade National Committee's annual celebration dinner, once again warning the U.S. He said, "Cooperation benefits both countries, while confrontation harms both. We should choose dialogue over conflict and mutually beneficial cooperation over zero-sum games." Arthur Kroeber, founder and partner of the economic research firm Gavical Dragonomics, stated that if the U.S. imposes high tariffs on Chinese goods, the yuan's exchange rate could drop by another 9 to 10%, reaching around 8 yuan to the U.S. dollar, the lowest level since 2006. In response, some former U.S. government officials have said that if China attempts to devalue the yuan before Trump takes office, it could risk angering the Trump administration, potentially leading to even higher tariffs. Fred Newman, chief China economist at HSBC, said that adjusting the exchange rate is a policy choice that China has already put on the table. He explained, if China takes the currency aggressively lower, it raises the risk of a tariff cascade, and other nations then essentially say, well, if the Chinese currency is weakening dramatically, then we may not have a choice to impose import restrictions on goods from China ourselves. Newman pointed out that the risk is that a sharp devaluation of the yuan could provoke backlash from China's trade partners, which would be detrimental to China. The impact of the yuan's depreciation on the Chinese economy is multifaceted and affects various economic sectors. One benefit of a weaker yuan is that it can boost export growth. A lower yuan means foreign buyers can purchase more Chinese products with the same amount of foreign currency, making Chinese goods more competitive in international markets. This is particularly beneficial for export-driven industries, such as manufacturing and electronics. In the short term, the yuan's depreciation could help ease the pressure of tariffs and influence trade imbalances in certain countries. Additionally, by intentionally devaluing the yuan against the dollar, China could disrupt the global trade market, and countries in Asia with close trade ties to China would see their currencies fall as well. China is one of the world's largest importers of goods, especially in energy, metals, and agricultural products. A weaker yuan would increase China's import costs, impacting global commodity prices. If China's demand remains strong while prices rise, global commodity prices could be affected, further driving up global inflation. As a result, the U.S. dollar would face pressure, and the international trade market could suffer significant disruption, a scenario that the U.S. and Europe would most likely prefer to avoid. Another negative consequence of yuan depreciation is that it would raise the price of imported goods, putting pressure on businesses that rely on imports. The higher cost of raw materials not only pushes up product prices, but also affects consumer purchasing power, leading to lower profits for businesses and further undermining investor confidence. Therefore, the depreciation of the yuan could make foreign investors wary of China, while Chinese capitalists and wealthy individuals might also be concerned about the further weakening of the yuan and choose to move their assets overseas. China's deliberate weakening of the yuan harms the world and severely damages China itself. This aligns with Xi Jinping's statement that cooperation benefits both, while conflict harms both. In order to cope with Trump's tariffs, China may be willing to take drastic measures. Over the past 2 decades, China's rapid development has led to significant accumulation of foreign exchange reserves. According to official data released earlier this year, China's foreign exchange reserves stood at $3.2 trillion as of December 2023, with an increase of $66.2 billion in December alone, a rise of 2.1%. With such substantial capital, China has the means to disrupt international markets. As for domestic businesses, China is not concerned about spending more to purchase imported goods, as the government has long subsidized export-oriented companies. In efforts to dominate international markets, many Chinese products are exported at prices below cost. The government's primary concern is its international standing and influence, while the well-being and living standards of the Chinese people are not its main priority. With China's real estate market crashing and the collapse of private enterprises across the country, unemployment is rising and social discontent is growing. In response to this unrest, the Chinese government has chosen to target wealthy business people, focusing on the financial sector. On December 13th, Harold Tybalt, a reporter from Le Monde in China, reported from Shanghai that China's financial sector is under pressure from the Chinese government to abandon profit-making in favor of common prosperity. The article stated that, in the past, the financial sector was seen as a pathway to success, but now it has become one of the targets of a major crackdown by the Chinese Communist Party. During Xi Jinping's 12 years in power, the direction of China's development and the role of the Chinese Communist Party in economic affairs have become increasingly clear. After 2 years of regulating internet giants, it's now the turn of the financial sector to be scrutinized. In a time when economic slowdown could further fuel social dissatisfaction, the concept of common prosperity has been used as a catchphrase to fight inequality. Recently, under the investigation of the powerful Central Discipline Inspection Commission, several officials from state-owned major banks, investment banks, and securities firms have been arrested. On November 26, Liu Liange, the former president of the Bank of China, one of China's 4 major banks, was sentenced to death with a 2-year reprieve. He was accused of accepting bribes equivalent to 15 million euros by approving loans worth 400 million euros. Former deputy governor of the People's Bank of China, Fan Yifei, was sentenced to the same punishment in October, and Wang Bin, the former chairman of China Life Insurance, was sentenced to life imprisonment in September 2023. On November 20th, Caixin, a Chinese economic magazine, revealed that Tao Zhongwei, the vice president of ICB AXA Life Insurance, a joint venture between AXA Insurance and the Industrial and Commercial Bank of China, is under investigation for corruption. There has also been an increase in arrests within security trading firms, such as Zhang Chengjun, the former vice president of Haitong Securities. He was detained after traveling to Laos in July and was extradited to China in August. Chinese media widely published his arrest photos, while the CCP boasted about its ability to pursue suspects abroad. According to Bloomberg, the salary cap for the Chinese financial industry is now set at 380,000 euro. In 2024, executives and traders from banks like China Merchants Bank, Everbright Bank, and CITIC Bank were forced to forego bonuses, with some even required to return previously received payments. China International Capital Corporation, CICC, cut salaries by 25%, leading some employees to seek jobs in Hong Kong. In Shanghai, one bank even changed its office location to avoid drawing attention. Commentators suggest that after the crackdown, China's financial sector may only provide funding for projects directly related to the CCP to preserve its own existence, which could further dampen the country's economic outlook. Despite the CCP's increasing crackdown on wealthy business people, strict capital controls, and the limitation of annual foreign exchange purchase quota, large amounts of capital continue to flow out of China under the noses of regulators. This outflow is much larger than the capital flight in 2015 and 2016, which was triggered by a downturn in the real estate market. In the past year, China has experienced a significant capital outflow. According to the Wall Street Journal statistics from October, $254 billion in illegal capital left China in the year leading up to June. Analysts note that, in addition to the impact of the COVID-19 pandemic, the government's crackdown on the private sector has caused people to lose confidence in the country's economic direction. Those with resources and financial means have come to believe that China's era of rapid growth has come to an end. The collapse of China's real estate market and uncertain economic prospects have also been key drivers behind the capital flight. According to Barclays, the epic real estate crash in China since 2021 has likely wiped out around $18 trillion in household wealth. To circumvent government controls, people have resorted to various old methods, such as smuggling valuable items abroad or overpaying for imported goods. Some business owners have also set up shell companies abroad in the names of family members, and then used these overseas companies to acquire shares in their China-based enterprises, transforming them into Sino-foreign joint ventures. This allows them to transfer funds overseas in the form of dividends and other payments. Another method for transferring funds is through art. An insider at a major auction house explained that the process is simple. Valuable artworks such as paintings are sent to Hong Kong for auction, and the proceeds are stored in foreign currencies like US dollars in Hong Kong, which has no capital controls. The seller then transfers the money out of Hong Kong. Another method for transferring funds is through cryptocurrency. Although China banned crypto trading in 2021, setting up cryptocurrency wallets is not illegal. Chinese people can use intermediaries to buy crypto assets with RMB, then transfer the crypto onto computer hard drives and ship them abroad, where they can be exchanged for cash. Even before Trump takes office, the CCP has already caused global unease with its actions, and the hearts of the Chinese people were unsettled. The economic policies devised by the CCP may be even more audacious compared to Trump's last term. During Trump's first term, he accused China of stealing U.S. intellectual property and commercial secrets, and under Section 301 of the U.S. Trade Act of 1974, called for tariffs on $60 billion worth of goods imported from China and other trade barriers, to force China to change its unfair trade practices. This marked the beginning of the first U.S.-China trade war. In response, the CCP implemented a series of countermeasures, including devaluing to promote exports and offset the impact of tariffs. Trump tweeted a warning, claiming that China was manipulating its currency, and urged the U.S. Federal Reserve to act. In August 2019, shortly after the yuan-to-dollar exchange rate broke the 7 yuan mark, U.S. Treasury Secretary Steven Mnuchin declared that the U.S. government had determined China was manipulating its currency. This was the first time in 25 years that the U.S. labeled China as a currency manipulator. The U.S. Treasury also accused China of violating commitments made at the G20 summit to avoid competitive devaluation. However, the CCP denied manipulating the exchange rate. Yi Gang, the governor of the People's Bank of China, stated that while the yuan's exchange rate had fluctuated due to external uncertainties, he remained confident that the yuan will continue to be a strong currency. As a punishment, Trump announced tariffs on nearly all Chinese imports to the U.S., escalating the trade war. The concept of a currency manipulator comes from the U.S. Treasury Department, which uses 3 main criteria to determine if a major trading partner is involved in currency manipulation: a significant trade surplus with the U.S., a large bilateral trade surplus with the U.S., and persistent one-sided interventions in the foreign exchange market. Once the U.S. determines a country to be a currency manipulator, the Treasury will hold negotiations with that country to address the issue. Otherwise, the country could face sanctions. During the 2008 financial crisis, the yuan appreciated significantly, with the exchange rate going from 7.8 to 6.8 against the dollar. To stabilize the yuan, the Chinese central bank pegged the currency to the dollar, maintaining the exchange rate between 6.8 and 6.89. Since the start of the trade war in 2016, the yuan has faced downward pressure, but the Chinese authorities have consistently slowed the depreciation rate, using large amounts of foreign exchange reserves to prevent the exchange rate from falling below the 7 yuan mark. However, the depreciation of the yuan is a double-edged sword. On one hand, it boosts exports and helps reduce the impact of higher tariffs on Chinese exports. On the other hand, if not managed properly, currency depreciation could lead to significant consequences, including large-scale capital outflows, market instability, and increased financial risks in the real estate sector. At the time, economists believed that the yuan's exchange rate breaking the 7 mark was intentional, with the CCP using this as a response to the US's threat of imposing a 10% tariff. Between March 2018 and May 2020, during a series of retaliatory tariffs, the yuan depreciated by more than 12% against the dollar. Now, a new wave of yuan depreciation is beginning. With 2024 drawing to a close, more and more of China's lower-income citizens are finding themselves in difficult situations due to unemployment. On December 15th last year, Xinhua News Agency published a commentary stating that GDP has doubled in 10 years, and China's economic strength has made a historic leap, solidifying its position as the world's second-largest economy. However, on December 4th this year, the People's Daily published an article stating that China's economy does not worship GDP, nor does it insist on achieving specific growth rates. This sudden shift in tone highlights the poor state of China's economy, with the authorities being forced to abandon false GDP data. On December 7th, Chinese media reported that the director of Zhejiang University's Institute of Sharing and Development estimated that China currently has about 900 million people who have not reached the middle income standard. Moreover, there's a large income disparity within this group. The commentary pointed out that China's rapid economic decline is leading it back to a collective poverty era, which also signals social instability. Next January, after Trump takes office, China is expected to experience tremendous changes.